All right, well, good afternoon, everyone. Thank you for taking time out of your busy schedule to attend this webinar today. My name is Corbin Granger, and we're going to be talking for a few minutes today about the Patient-Centered Outcome Research Institute fee, otherwise lovingly known as the PCORI fee. If you haven't attended our webinars in a while, we do post them under TowneBenefits.com under our news and webinar section. So they will be posted, the recording, in about 1 to 2 days. I will also send you the link, copy of the slides, a copy of the form, and a copy of the instructions. If you have a question, feel free to put it in the chat box and we'll go through it at the end of the presentation. So with that, let's get started. And I am not an attorney, nor am I an accountant, and I'm also not qualified to play one on TV. So just so you know, this is based upon information from the IRS or DOL or HHS. And so we don't ever want this to be construed as legal or tax advice. Please, we always recommend before you submit any tax form to contact your tax consultant or your tax specialist. Now, what is the PCORI fee? So for anyone who's new to the PCORI fee, it actually applies under the Affordable Care Act, and it's funding a particular institute that happens to be located in Washington, D.C. And this institute's entire goal is to develop things and look at research to improve patient outcomes in medical care. So for example, years ago, if you had a knee replacement, they would put you in a cast. And then they realized that people's outcomes in many cases were worse than they were before, and they never really were able to regain full function of the knee. So now we get people up and we get them moving right after surgery. So the same thing, whether it's diabetes or whatever condition it is, how can we create therapies? How can we create better things to increase patient outcomes? Now, this fee applies for plan years that end before October 1, 2029. So that's really September 30th of 2029. However, it may be extended since it is funding a specific institute, but we'll have to see. Now, the fees are due annually using Form 720, and that is a quarterly excise tax return. And if you haven't seen a quarterly excise tax return, it involves a lot of things about diesel, all sorts of different things that have excise taxes on it. So it isn't a form that was created for the PCORI fee. We're going to go through the form and I'll show you the small section that you complete. And you're doing this because your plan year ended in the prior calendar year. So the PCORI fee for plan years ending in 2022 are due by July 31st of 2023. Okay. Now, what are the employer plans that pay the PCORI fee? The plans that pay the PCORI fee are self-insured health plans. That sometimes is called, if you have Optima Business Edge, maybe called balance funding, maybe called level funding. You may have a full self-insured health plan. And that the reason you, the employer, pay the fee is because under the law, you are considered the issuer of the plan. Now, if you have a health reimbursement arrangement, and that's an arrangement where the employer funds to help employees with deductibles or copays or various medical expenses, and you have also a fully insured health plan, you will have to complete the PCORI fee just for that HRA. If you happen to have, and this sometimes gets confusing, if you happen to have a self-insured health plan and you have a health reimbursement arrangement as well, then you only file for the self-insured health plan. So you're only filing one fee. So if you notice, if you have a health reimbursement arrangement, you're going to be filing the PCORI fee, but also the carrier has to file a PCORI fee. So the government gets actually 2 fees in that case. Now, if you also have either a standalone health reimbursement arrangement that might be what we call a qualified small employer health reimbursement arrangement, known as a QSARA. That's where you don't have a group health plan, you're not a large employer, and the employee is giving money towards the purchase of insurance. The same thing with an individual coverage health reimbursement arrangement, also called an ICRA, which allows individuals to purchase individual coverage. So before I move on, I want to stress, if you are an employer that has a fully insured health plan, you don't have a health reimbursement HRA, you don't have a standalone HRA, and you just have a fully insured plan, you do not pay this fee. It only applies to clients that have a self-insured health plan or a health reimbursement arrangement. So how is this fee calculated? The total PCORI fee is calculated based upon the average number of covered lives. So here we're talking about total lives covered. So it will be the employee, the spouse, and any dependents. And then that's going to be multiplied by the PCORI fee for that year. Every year, the fee is adjusted for inflation by HHS. And interestingly enough, this is one of the weird situations where the fee changes every October. On a lot of tax forms, the fee or the cost or the tax rate lasts for the entire calendar year. But on this one, and you'll see it on the form, it depends upon when your plan year ends as to what fee you're going to pay. So for example, you pay $2.79 per covered life for a plan year that ends as of September 30th, 2022, right? That's before October 1. You're going to pay $3 per covered life for a plan year ending in October, November, and December. So if you have a plan year that ended in January through September of 2022, you would pay the $2.79 per covered life. If you had a plan year that ended in October, November, or December, you would pay the $3 per covered life. And we'll show you where that is on the form. So I'm going to switch gears now to go over how you count the average number of covered lives. And you count it differently whether you're a self-insured health plan or a health reimbursement arrangement. So this counting is for the self-insured health plan. There are 4 methods to count the average number of covered lives, and there are 2 that are actually pretty popular. So the first method is called the actual count method, and you add every covered life on each day of the plan year. So again, that would be the employee, the spouse, and the number of dependents on every day of the plan year, and divide that number by the total number of days in the plan year. So that actually involves a lot of work, and that's not a method that's usually very popular. The next 2 methods are, we find them to be more commonplace. The first one is called the snapshot count method. The snapshot count method adds the actual covered lives on at least 1 day per quarter and divides them by the number of days used. So you have to use this number of days in each quarter. You can use 1 day, you can use more than 1 day. I would say just use 1 day. And then the date must be within 3 days of the date in the other quarter. So for example, you could choose the first day of the month. You could choose the last day of the month. You could choose the 15th day of the month. It doesn't matter. It just needs to be the same day. And all the dates have to fall within the same policy or plan year. So for example, if you had a plan year beginning in January, you could do January 1, April 1, July 1, October 1. You take that count, you divide by 4, and then you're going to multiply it by the fee that applies for that plan year. Same thing, you could do February 1, May 1, August 1, November 1, You could use the second month in each quarter, or you could use March, June, September, December, the third month in each quarter. So it's relatively easy. You're just looking at capturing sort of a snapshot and then dividing that number by 4, unless you want to choose more dates. The second method is what's called the snapshot factor method. And this one, if you don't have a TPA or a carrier who provides you the count, this is a good method to use. So in this method, what you do is you look at the number of lives covered on a date is going to be the total of the number of participants with self-only coverage, and then the number of participants with other than self-only coverage. So that might be employee plus spouse, employee plus child, employee plus children, family coverage. And then you take those and multiply it by 2.35. So you might have 10 people with self-only coverage. You might have 10 people with other than self-only coverage. And so you're going to take those 10 with other than self-only coverage and multiply it by 2.35. And that gives you 2350. So then you would add the self-only, the 10 to that. So that would give you 3350. And you do that on the same date each quarter, and then add the totals up and divide by 4, and that gives you your calculation. The last method, you would have to be subject to a Form 5500, which I imagine a lot of clients aren't. You would also have to have your Form 5500 in by July 31st. Basically, we don't have any plan sponsors who only offer individual coverage. So let's say the plan sponsors, if you offer other than individual coverage, you're going to take the number of participants reported at the beginning of the plan year plus the number reported at the end of the plan year. So you have to make sure that the relevant Form 5500 will be filed by July 31st. Now, as I mentioned, that applies to self-insured health plans. There's a special rule for counting health reimbursement arrangements, and it's very simple, really. So if you happen to have a fully insured health plan and you have an HRA, you are only going to count the lives for the HRA. You just use the 1 life per participant rule. So in other words, if on January 1st you have 30 people in there, in the next quarter you have 50 people in there, that's what you're going to use. You're not going to include spouse and dependents. So you'll still use one of the same methods, but you're not, when you're looking at actual covered lives, you're only counting 1 life, basically the employee. If you have a standalone HRA, a qualified small employer HRA, an individual coverage HRA, it's the same thing. You're only going to count 1 life per participant and use the same set of rules. If you have an HRA that's integrated with a self-funded plan, so as I said earlier, you have a self-funded plan, but you also have an HRA, you're only going to use the average number of lives of the self-insured health plan. So what that really means is you're going to look at actual covered lives. You're not going to pay a separate fee for the HRA. You're just going to use the method that applies to the self-insured health plan and report that way. And that way you only pay 1 fee for the self-insured health plan and the HRA. Now let's move for a moment and talk about completing Form 720. So Form 720 is an 8-page quarterly excise tax return. But if you're filing the PCORI fee, you only file it for the 2nd quarter of the year following the end of the plan year. So page 1 is taxpayer information. Page 2 is the PCORI fee section. Page 3 is where you calculate the final tax, and then the payment voucher is down at the bottom of the form, usually around page 8. So here is a screenshot of page 1 for 720. You have the employer name. If you notice, you're going to put second quarter ending in the current year, not the year you're filing for, but the current year. So that will be June 30th, 2023. Your street address, your employer ID, your city, state, zip code, and then you're going to go to part 2, and that's going to be line 133 on page 1. So after you complete that section, you're not going to complete any other part on page 1. And in the middle of page 2, you will find part 2. And this is the section of the excise tax that applies to you. So you go to line 133. I've actually circled that in red because you have a self-insured health plan, and you're either going to complete on line C because you have a plan year that ends before October 1st, 2022, or D if you have a plan that ends in October, November, or December of 2023. So you're going to multiply the average number of covered lives from A, you complete it in the little blue section, times the rate per average covered life. Then you put the fee on line C, and then you put the total under the tax column that's blue. You're going to total the tax at the bottom of page 2, and then you're going to carry it over to page 3. So page 3 says the total tax. You add part 1, line 1, and part 2, line 2, and so that's going to be the PCORI fee. You're going to complete 4 through 9. You're not going to have any claims. I doubt you'd have any deposits made for the quarter. Probably don't have an overpayment. And if you had sent in a 720X, and that would be an amended return, then you would include that. If that applies, that would be very rare. And then you're going to add lines 5 and 6, should be 0. Add lines 4 and 8, that's probably 0. And you're just going to carry down from line 3 to line 10 the balance due. Once you do that, you probably want to have your CPA review it before you submit it, since I am not an accountant or a tax specialist. And the signature authorized party or paid preparer will sign the form. So it's actually a very simple form to complete. This is one of the simplest forms under the Affordable Care Act that you get to do for anyone who's used to doing the applicable large employer forms or the other forms. Last, if you wish to send it in by mail, you can get the payment voucher at the end of the form. You're going to enter the amount of the payment. You're going to make it out to the United States Treasury. You're going to indicate it's for the second quarter, and you're going to mail it into the IRS. If you don't mail it into the IRS, you can use the electronic tax payment system for the second quarter. And so for your convenience, on another slide, I do have the address to which to mail it and the instructions for e-filing it. Now, we reached out to some carriers in terms of what they provide for the PCORI fee, and it really varies among the carrier. If you don't see your carrier or TPA on here, feel free to talk with your client service specialist or your broker, really. So with Optima, they don't provide a specific report, but they said you could use the monthly funding report, and we're happy to help with that. So if you use the snapshot count, or if it's the snapshot factor method, that probably works very well with Optima. United does provide a membership report by month, calculating the average number of covered lives. Cigna has an employer portal. You go to reporting, then you go to government, then you go to CRA report. Now I put an asterisk there because it is the PCORI fee, but it's also known as the Comparative Effectiveness Research Fee, and so that's what Cigna calls it. You then put in the date range and run report. Trustmark actually sends the employer a letter showing the average number of covered lives. So hopefully you have received that or will receive it very soon. Anthem does not provide a report. They suggest you can use the bills, or we could request the information from there to help you with that. But those are some of the responses I received in terms of how the carrier or TPA will provide that information. So how do you file it and where do you file it? You can file it. The instructions are on page 2 of the IRS instructions that I will send you. You send it to Ogden, Utah, and if you want to electronically file it, then if you have the ability to do that, you can certainly do that as well. Now, I do want to switch gears for a moment before we close and just let you know that there is a new e-filing requirement for 1094 and 1095B forms. So even though we're talking about 2022, if you are currently maintaining a self-insured plan in calendar year 2023, you'll probably be required to electronically file these forms. So self-insured health plans are subject to filing the 1094, 1095B with the IRS. Many plans in the past have submitted these in paper. Moving forward for the 2023 reporting year, every employer has to file, unless they can prove a hardship, unless they file fewer than 10 returns. And that includes your W-2s, your 1099s, and a bunch of other returns. So I imagine even if you have 7 employees and you may have 4 people come and go during the year, that's 11 W-2s right there. So you would have to file electronically. It also applies to applicable large employers that have been filing in paper. Again, it's subject to 10 returns. There is a way to file it through the Affordable Care Act Information Return System, or the AIR system, but you have to set up an account with the IRS, and that's 30 days or more. We're looking at some solutions. We also have some software referral to provide, but we're all looking at that, and so we just want to let you know that if you've been filing these in paper, it's pretty likely that you'll have to file them electronically for the 2023 reporting year. Again, we always like to encourage you to review it with your CPA or tax specialist. This is a relatively short webinar because the Form 720 isn't a very complicated form, as long as you're just doing it for the PCORI fees. And before I end and go to questions, I'd like to say we're introducing our podcast. Barbara Jennings and I have worked for about a year to create a podcast. It's called HR on Mic. Again, you go to townebenefits.com, news webinars, that's HR on Mic, and that's also where we post our webinars. We encourage you to listen to it. Our goal is to provide just little snippets of information upon questions or topics that are of interest to our clients. So if you have something that's of interest, please send it in. We've just posted our first 2 episodes. The first one is 5 minutes. I think the next one is 7 minutes. So if you're interested in that, let us know. Our goal is to put them out roughly every 3rd Wednesday, and we hope you enjoy it. So with that, thank you so much for attending, and I'm going to go ahead and open it up to see if you have any questions. I do see one question, I think. Actually, I don't see a question in there. I'll just wait for a second to see if anybody has any questions. Okay, well, I don't see any questions. I'd like to put my email up there again. Again, we're going to post the webinar to our Towne Benefits site, and I will also email you a copy of the slides, the link, and copies of the form and the instructions. And if you have any questions, let me know. Otherwise, I hope you all have a wonderful Happy rest of your day. It really is a privilege to work with each and every one of you, and I wish all of you a very happy holiday. Thank you so much. Have a great afternoon.